Good morning from the poorest person you will ever know that actually follows Wall Street. And there are times I follow it closer than others, but some days I'll spend an hour, hour and a half, 2 hours poring over P&Ls, quarterly reports, financial stuff. I want to see how much debt they have, how much profit they're actually making, how much their payroll is. So yeah, I'm the poorest person that you'll ever know that follows Wall Street, which means you shouldn't listen to anything I say, because if I was real good at it, then I'd be making more money. But in my defense, I was later in life before I ever got involved with how markets work and how investing works. You know, my returns right now are pretty decent, but I am not an expert, but neither are those guys you see on TV. They're not either. They just think they are. At least I know I'm not. But today, this is a very interesting topic, and one that you should know about. If you invest at all, you should know about today's topic. It's called stop loss. What is a stop loss, and how come more people aren't using it? The definition of stop loss is denoting or relating to an order to sell a security or commodity at a specific price in order to limit a loss. That is true. But I think it's more useful to protect your gains. You see, a stop loss is very useful if you're a speculator. In other words, if you're a gambler. If you take your money and just roll the dice and gamble that this company is going to go up very fast, or short selling or something like that. And I don't know anything about short selling. I don't do it. I don't want to do it. So I don't know if you can even do a stop loss in short selling. Probably not. But let's say that Ford hit a 52-week low, and you're going to buy 1,000 shares and sell it in a few days when it goes back up. So you do that. But it starts falling more, and you don't want to lose a whole lot of money. You can put in a stop loss, or let's say Ford is $9 a share. You put in a stop loss for $8.25, we'll say. That way you only lose 75 cents a share. If it drops to $8.25, it automatically sells. You don't have to do anything. That way you didn't lose any more than necessary. But I'm the type, I like riding losses out. I don't like selling when I'm at a loss. I like riding it out no matter what. But I'm not perfect in that, because yes, I've panicked like everybody else in the past, even though you shouldn't. Because in my opinion, you shouldn't be buying a stock you don't think is solid. If it's not a solid company, you shouldn't be buying it, in my opinion. But if you're a speculator or a gambler, then that's all it's about. And this year, I decided to take a very small percentage of my retirement in my Roth IRA and gamble with it, speculate with it. Because it is kind of interesting and fun, but not something I suggest. So I took a measly $1,200. When I say measly, I mean, if I had $1,200 in my hand, I'd jump for joy. It's not a measly amount of money, only in the fact that when my wife gets 62 and we'll start drawing for the money, $1,200 isn't going to matter a hill of beans. You know, so I decided to gamble with that $1,200 because I wanted to invest in Carvana. Now, Carvana, if you don't know, it's a used car dealership that everything's done online. They'll deliver it to your house, or you can go pick it up at a Carvana vending machine. But the reason was because this company, even though I believe could be huge in the future, I also believe they could be bankrupt in the future. So I wanted to invest, but I was a little bit worried about it. So I decided I'd take $1,200 and roll the dice and gamble. And I bought it for about $30 a share. I think $30.12. And so anyway, I told my wife, I said, in 5 years from now, this stuff we paid $30 a share for might be worth $200. Then again, it may be worth $0. So I bought 40 shares. April 19th, 2018, 40 shares of Carvana stock, $30.16 a share price, and that includes my fees. I spent $1,213.43. Then it started skyrocketing. It got up to about $70. Somewhere around $69 or $70, I put in a stop loss to protect my gains, which is not really what it's for according to the definition, but I put in a stop loss to protect my gains. And I calculated how much I would need to sell them for to keep half my shares and get my investment back. That way, I've got 20 shares for free. And the way I look at it. So anyway, on September 5th, it did drop. I put in a stop loss for $61.18. It dropped from somewhere around $70 over the course of a few days or a week and a half or two. And it dropped down to $61.18 and triggered a sale. and I got $1,216.65. So now I've got 20 shares, which actually cost me nothing in real dollars and $3 to boot. Because Carvana stock this year has gone up and down, up and down, up and down. It's ridiculous how much it's fluctuated. Well, I decided to buy Ford stock with it because it was a 52-week low for the next day for $9.45. But it fell even lower and got down to low 8s, but I didn't panic and sell. You know, this is where a stop loss would have came in handy for a lot of people. I didn't do it. I was going to write it out. I don't care if I kept it for years because it did have a 6% dividend so long as they don't cut that. Well, luckily, it went back up pretty quick within a few days, and I sold at $9.54 and went, whoo! Oh my gosh, I'm glad I didn't lose money on that. And I made $5. $5 measly dollars. I took that money and Carvana was dipping again. So I bought 31 shares of Carvana. So right now I have $1,205 invested in Carvana. Actually $1,202 because of the $3 I got from the first sale. $1,202 invested in Carvana, and I've got 51 shares. 51 shares right now, which for me to actually lose money had to drop to about $23 or something like that. Now, it's pure luck. It's not genius that I bought it yesterday. It's pure luck. But the first day of me owning it, it's up over 7%, $41.59. But I bought Carvana because they're still expanding, and they've had multiple quarters of triple-digit gains because of their expansion. And Wall Street always overreacts to good and bad news, always. And if they see triple-digit growth, quarter after quarter after quarter, that's all they're going to see, and it's going to drive the stock price up, I think. You know, but eventually, if that's all you've got, then it's going to come crashing down, or you're going to get it's going to come back down later. You know, because Carvana is not making any money; they're losing money, and you know, they've got to figure out a way to make a profit, just like Tesla had to, and so far, you know, Tesla did last quarter. So I'm hoping that's Carvana's future. We'll see. A book I read earlier this year, which was talking about stop loss, which made me think about it. I've never thought about stop loss before. I didn't even know for sure what it was. This book I read said everybody should have a stop loss on every stock they own. He pointed to 2008, where a lot of people lost up to 50% of their value in their IRAs and their brokerage accounts, lost up to 50%, you know, within a year. And he said that if those people would have had a stop loss at, say, 20% below what the value was before it started, then they would have only lost 20% instead of 50%. You know, and I got thinking about that and thought, yeah, I think going forward, everything I own, after it reaches a certain height, you know, after the value goes up a certain amount, I think I'm going to put in a stop loss. Now, it's got to be at least 20%. I'm going to have to get at least a 20, 25, or 30% return before I put in a stop loss. But once it does, I think I'll always put in one. Let's say I have something that's gone up 30% since I bought it. I believe I'll put in a stop loss maybe if it loses 15%. The only risk with that is if it's a holding you want to keep, let's say it's up to 40 and you put in a stop loss at 30. If it drops to 30 and sells, then immediately starts climbing back up again, then you're going to have to make a decision whether you buy it back for more than you sold it for, or you're going to have to just do without it and not, you know, just don't have it in your portfolio. So that's the only danger to a stop loss. If it drops to that amount where you trigger to sell and that's as low as it goes and shoots right back up and never comes back down, you know, that's a little bit of a risk. But I still think a stop loss, people should use it a lot more than they do. It doesn't cost any more to a brokerage firm. You know, where I do is $6.95 per trade, whether it's a stop loss, market limit, doesn't matter. Anyway, y'all should consider doing a stop loss if you're investors. You should really consider it on at least some of your stocks. And you're guaranteed, if you do a stop loss and it sells, you're guaranteed never to sell at the height of the price. That's a guarantee. But you know what? You're not going to anyway unless you get lucky. Like my Carvana stock was hovering around $70. I think it might have reached 70. I did the stop loss around 68 or 69. Yeah, $61. I sold it at $61.18. Now, a lot of people say you could have sold it at 68 and 69. You lost money. Well, yeah, I did. but it was going up and down, up and down. There was no guarantee it wasn't going to go back up again. So you will never sell at the height of the market or buy at the bottom of the market unless you just get lucky. So don't worry about that. Don't worry about it. Just protect your gains or limit your losses, whatever kind of investor you are. And man, you'll be a lot better off. A lot better off. But sometimes it's better to be lucky than good. Sometimes it's better to be lucky than good. You look at Carvana here. I now own 51 shares. I have $1,202 invested, including my fees. My cost basis is $23.57 a share. And right now I'm up 76%. But that could have easily gone the other way. Now, my Tesla hating cousin, he believes they're going to be bought out by somebody. And they very well might, because everybody gets bought out these days by Apple, Amazon, somebody. As a matter of fact, if I was Jeff Bezos, I'd be looking at it. If I had his kind of money, I'd be taking a hard look at it. Oh, one more thing. Now, I sold at $61 and it kept dropping and dropping and dropping down to 38. If I hadn't had a stop loss, then it would drop to 60, 58, 57. At that point, I've been thinking, oh crap, I should have sold when it was in the high 60s. It dropped to 55, 50, 45, 40. It would have dropped all that way. And right now, I wouldn't be near as much as I am. By doing a stop loss and it triggering a sale at $61 and me watching it fall and buying it again when it dropped quite a bit, then if it rises back up, here's my plan. If it rises back up, because it is a risk, it's not a solid investment, it is a gamble, because of that, I will sell them again. But I'm going to keep as many shares as I can that I can get for what I call free. Now, the way the IRS calculates it, I didn't really get them for free. But my calculations and the way I think is you add everything you've put into it, you subtract everything you've gotten out of it, and when I sell the next time, I will have nothing invested. I'll have anywhere from negative $5 to positive $5 invested. And so that's my goal. And then whatever happens after that, I didn't pay any real money for them anyway. If they go bankrupt, then okay. If they go to $200 a share, which they might, then that'd be great. But we'll just see how many shares I can accumulate. Always remember to adjust your stop loss. If you're doing it to protect your gains, that is. If you bought something for $30, it's up to $60, and you want to protect those gains, you put in a stop loss for say $50, and then it goes to $68, $69, you may want to adjust it to sell at $55 or $60. Then it goes to $75, you may want to adjust it to sell maybe whatever you want to do. Let's say you want it to, if it drops more than 20%, you want to sell. Then if it's at 55, you'd want to set it at 44. That's 20%. Then it goes to 60, 20% of that would be 12. You'd want to set your stop loss at 48. And you can also set it up to automatically sell if it drops a certain percentage below the 52-week high. If you want to do that. I don't want to do that myself, but you might. So let's say it hits a 52-week high of $70 and 20% of that would be 14, it'd be $56 is where the stop loss would automatically set. Then if it goes to 75, well, 20% of that is 15, the stop loss would automatically adjust to $60. You can do that as well. That way you never have to mess with it and it's adjusting on its own. Which I can see the attraction to that. It's always adjusting on its own and you don't have to do anything once you set it up. But yeah, always adjust your stop loss if you use one. But anyway, that's all I'm going to say about it. Stop loss is a great tool that hardly nobody knows about. Even those that invest, a lot of people don't really know what it's for. So there you go. Hope this video helped. And y'all have a great day. And thanks for watching.